Welcome to a special report of oil and gas investor headlines for the week ending January 15th. I'm Heather Rosenbaum. Before we get started, I want to take a moment to thank our sponsor, Navport. For more information on their upstream data solutions, visit navport.com. We're in a very different place now than this time last year. At the start of 2015, crude prices were dropping, but experts predicted an optimistic $70 per barrel low. Instead, we ended the year with prices in the upper $30 range. According to reports from the U.S. Energy Information Administration, 2015's monthly aggregate average plunged to less than $50 per barrel, not including December figures. Compare that to 2014's average of $93 per barrel, a 47% decline. Rig counts have already bogged down. So what does this mean for production and completions? One analyst explains.
From the peak in the production market, which was experienced in February, which was roughly a 5-month lag from the oil drop, we've seen a 28% drop in production. Looking at that same 8-month span in completion counts, we've seen a 57% drop in completions, double what we've seen in production.
Turning now to our cover story for January's issue of Oil and Gas Investor magazine. Good old-fashioned oil and gas talks about how conventional producers continue to tee up compelling and rewarding onshore prospects in spite of shale love and low prices. Featured is San Antonio-based private E&P RLU Oil and Gas, which has managed to find returns on investment even as commodity prices bottom out. Check out Oil and Gas Investor magazine's January issue for more. Thanks for watching this week's Oil and Gas Investor headlines. Head on over to oilandgasinvestor.com for more on top stories in the industry. See you next week.